Hey everyone, this is Dimitri Pragmatic with MarketChameleon.com. I wanted to share an option strategy with you. It's called a double bear spread strategy, and it consists of two parts: selling a bear call spread for credit and buying a bear put spread for a debit. So let's just take a look at an options chain and set it up and see what it looks like in a diagram. So here I'm going to use SPY as an example, and I went to the SPY options chain here. Let's just expand it. And I went to the November 15th expiration, which has 14 business days to go. So let's start out with the call spread. We're going to establish a bear call spread. And the hardest part to do is really figure out which strikes you want to use. If you already have an opinion where you think the SPY is going to go, then it makes it easier. But in this example, I'm just going to use our historical statistics. And here I see that with 14 days trading days to go, historically SPY over a 14-day hold period, 64.8% of the time it's finished higher. So it has a positive drift, and the average return is 0.6%. So over a 14-day hold period in the last 4 years, the average return has been 0.6%. So that's what I'm going to use to target my short strike in this example. And here I'm going to go in SPY. Right now it's 303.30. So I'm going around the strikes. I'm finding what's 0.6% higher. So the 305 strike is 0.5% higher. The 306 is 0.8%. So let's start with this, a 305 call. I'm going to start selling that for, I'm going to click on the bid to sell it at $2.14. So then I see a sell November 305 call for $2.14. And I want to stop myself out because just in case we're wrong and the stock just goes up or rallies really hard, I want to have a stop here. I'm just going to go up in this example to the 308 strike and buy it at 99. So that's where I'm going to stop out at 308. So here sold the 305. We sold a bear call spread, the 305 308 call spread. We see here we sold the 305 calls for 214. Bought back the 308 calls for 99 cents. So that's for $1.15 credit. The next thing we want to do is buy a put spread, right? Because we're feeling bearish, and if the stock goes down, since we feel bearish, we kind of want to enhance that return, because the most we could make here is the $1.15. So which strikes can we pick down? Of course, if you have an opinion where it's going to go and where it's going to stop around, it makes it easier. But since I don't really have an opinion about this, I'm just demonstrating an example here. I'm going to go to the historical statistics here. I'm going to hover over here. And what I see here is over a 14-day hold period, when SPY is up, the average of all the up moves is 2.3%. When it's down, the average of all the down moves is 2.5%. And over a 14-day period, we see the best, in the last 4 years, the best return was 8.4%. The worst return was 8.7%. So since I'm feeling bearish and I think, that it's going to go more down than up in this example, I'm going to say it's going to go down and probably stop around that 2.5% lower from here. So in a 14-day hold period, the average of all the down moves has been 2.5%. So let's find that strike first. I'm going to go hover over the strikes, find 2.4%. So here's 2.5%. So the 296 strike. So that's kind of, let's just choose that as where if it goes down, it'll stop around there in the next 14 trading days. So I'm selling this 296. And of course, I want to buy a put higher, right? Because I want to buy something higher because I want to profit from that put. Let's go. So I'm going to choose here. I'm going to go up to the 300 put. So now I'm buying the 300 put for 160. So you see here that I established a bear put spread for debit. I'm buying the 300 put for $1.60, and I'm selling the 296 put for 95 cents. So here, here it didn't take. Let me just click on that. So here it is. First, we have the call spread, the 305 308 call spread. We sold 305 calls for 214, bought the 308 calls back for 99 cents. Then we established a put spread, a debit put spread. We sold the 296 puts for 95 cents and bought the 300 puts for 160. So let's see what that diagram looks like at expiration. I'm going to load the strategy, and here's what it looks like at expiration. So the first thing I see is we received the credit for it, right? So this, because we sold the call spread and we received $1.15, then we bought the put spread and we bought that for what's that, 65 cents. So 50 cents total credit. And we see here that if the stock, right, just kind of hovers around here, if we're wrong and just kind of hovers around here, we receive that 50-cent credit. And you could see even if it goes up, this is where the spot is right now. If it goes up, we still receive that credit. And then right around 305.45, that's when we start losing. To the upside here, we see we're capped out. So if the stock really runs, right, and just keeps going, 308, 309, then we're stopped out, and for $250 loss with this strategy here. So we did all one lots, times 100. That's a $250 loss if it just keeps going higher. To the downside, you see, since we also long the put spread, and it just keeps going, goes to our target price, but if it just keeps going, then our max gain is $450. So you could see here, we established a spread that we feel bearish. Our potential upside, our max is $450. Our downside, if the stock really runs up, is $250. And then we have this middle part over here that if the stock really does nothing, we'll just collect that 50-cent credit. And that's an example of a double bear spread. Selling a call spread and buying a put spread at the same time. Hopefully this was helpful. Thanks everyone for watching, and see you next video.